is worth $75 billion. Taking your organization public.
The way I think about it, we kind of will be ready for in 2 years' time. But then again, depends on what the market is.
Since you don't have an idea, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell some portion of their stocks to external investors.
So you've done secondary sales for your employees. So employees can then get some liquidity. Do you expect before you go public to do any more of those, or are you just going to wait to go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years. So we might do secondaries as well.
All right. Well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank, it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power, billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television. Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Matei.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. Sector is really propelling the deal forward.
Yeah, the hope is that they'll open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The data is coming in so far good enough not to go in September.
If the Fed has to raise 1 or 2 times, we don't think that derails the broader story.
They've got to do something. The Fed should control what it can.
2 hikes may not cut it now, maybe 3, maybe 4.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Verdern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores of price action look like this. Equity futures on the S&P 500 bouncing back, still heading towards a week of losses, looking to snap a 3-week winning streak on the S&P. The Nasdaq, 5-day slide on the Nasdaq 100, bouncing back by 0.6 this morning. Some stability in the bond market. We rallied on Wednesday. We gave it back on Thursday. It's Friday, just about unchanged. 470 on 10s, 524 on 30s. Heading into this a week today, you'll get from Kevin Walsh, the Fed chair in Jacksonville, Wyoming.
And just how much more complicated has Scott Bessent made the job of Kevin Walsh, given some of the goals of Scott Bessent with respect to shifting the repurchases and, frankly, the implied issuance of the Treasury Department? It is really putting the emphasis on Kevin Walsh. Are you going to participate? Are you going to ease at the front end to allow the U.S. to lower its financing costs? Ultimately, let's see, he hasn't really wanted to expand the balance sheet. That's kind of been the opposite of what Kevin Walsh has said. Just how much will he reiterate some of the views that we heard back in 2008 and 2009 from Kevin Walsh?
They're responding to the pressure coming from elsewhere. The Treasury Secretary is responding to the pressure coming from this economy at the moment. The growth numbers look good, but people aren't happy with what's happening. They're looking to get interest rates down, looking to get prices down too. Check this out from the president just moments ago. Posting this on social media. I've concluded a deal to substantially lower the price of ground beef for working American families a little bit of tariff relief, Bramo, on the food front.
Yeah, and what can they do heading into the midterm elections to lower everyday costs at a time where it's not just the pace of increase, it's the all-in increase based on 2021 to 2025, which has superseded most people's paychecks. That starts to hurt in a really significant way. How can the president take action if the oil prices are still elevated? And frankly, if rates aren't going to go down anytime soon?
It's kind of a weird scenario, isn't it? Stock market 2% away from all-time highs. Credit spreads are tight. Unemployment's close to 4%, GDP close to 2%. And not many people are happy with this economy. And you've got to see intervention in the treasury market to keep yields low. You have to see intervention with trade policy to kind of try and get prices down. All of this into the midterms a few months away.
This is a lumpy economy. You can talk about the K-shaped. A lot of people are sick of talking about the K-shaped, including Scott Bessent, saying it doesn't exist. You have seen a little bit of convergence from a Bank of America study. Nonetheless, there has been a very different feeling for people at the upper end of the income sphere and people at the lower end of the income sphere. And everybody hates inflation. It doesn't matter where you are on it because your take-home pay could decrease even with raise on a real absolute basis. And that is what you've seen for a significant swath of the people in the United States. And they don't like that, which is understandable and historic and typically something that people rebel against, even if it takes time to fix.
The latest action from the president just moments ago. Coming up this hour, we'll catch up with Jack Caffrey of JP Morgan with stocks on track to snap a 3-week winning streak. Bob McNally of Rapid Energy warning crude could be heading back above triple digits. And Molly Brooks of TD Securities on what to expect from Fed Chair Kevin Walsh at Jackson Hole. We begin this hour with stocks heading for their first weekly loss this month as a volatile bond market overwhelms Washington's efforts to calm investors. Jack Caffrey of JP Morgan Asset Management writing, we now have a Treasury Department that is clearly more willing to intervene and perhaps offer its own version of forward guidance to markets actions. Jack joins us now for more. Jack, good morning.
Good morning.
What kind of guidance are you taking from that forward guidance?
Well, it's always interesting when someone who spent their career in markets says markets are wrong. I look at what's being proposed here, and I think you actually turn this into a money loser and certainly a cash flow loser. When you start buying bonds back that might have been issued 5 years ago with, say, 1.5 or 2% coupons, and you're going to refinance them at 4.2% using yesterday's 2-year yield. So that doesn't sound like it's going to achieve in the long term your policy goals. And you put yourself making for a very interesting resurrection of the Treasury Fed Concordant, I guess 1952, when the Fed was finally willing to let long rates actually be set by markets rather than by diktat. So that's sort of an interesting, I think, interesting pushback where governments theoretically are becoming more interventionist rather than less.
Far more activist. We saw something similar, not exactly the same, but something similar in Treasury Secretary Janet Yellen. She appeared to blink, tightened up issuance at the long end. That was a big opportunity to buy bonds, and actually, for that matter, stocks too, into year end. Is this different?
I think from an equity investor's perspective, to some extent, we might actually say the equity market is causing some of these problems. Because we sit here and we're going to talk repeatedly about what a great earnings season it's been. And yet at the same time, the cash needs of businesses have been rising even faster than their abilities to actually earn money. And I think that's not just an AI story, that's an energy story, that winds up being an industrial story, that becomes a healthcare story, where you have so much pressure on companies to shift their supply chains to try to reshore or friendshore their activity. We spent 25 years of the corporate sector being outsourced, capital spending to other people. Now you're putting pressure on them to actually bring that investment home, and effectively that means they have to spend it themselves. So the government needs money, given the level of deficits. The corporate sector needs money. And I don't want to say that I'm becoming bored with it. That's definitely not the right word, but almost numb. Like, we're going to raise $60 billion for AI spending here, $100 billion there. That's a lot of money that actually needs to get financed, and it makes you wonder, how quickly can we get the payoff?
Anthropic, just throwing around $2 trillion here and now.
$500 billion memorandum of understanding. It's sort of, people ask for their allowance at home. It's like, can I have $1 billion? It's like, I'll go to the bond market. There's a question about what point bond yields are going to crimp some of the ambitions that you're seeing for big companies. Why haven't we seen any of that yet?
Because the future is so bright, and you can continue to sell people on this is transformative. And how do you price transformation? And I think no one, to some extent, you can look, I think, at the AI channel, and they're engaged in an exercise in game theory, where they all view, if they don't spend, that it's an existential risk. And at this point in time,
the cost of financing hasn't actually been high enough to actually force a winnowing and a repositioning of people's business strategies, with maybe one exception, where one company seems to be moving away from its ambitions to be on the leading edge to try to be something more of an arms dealer in terms of deciding other models that might be more efficient. But they're being kind of quiet about how they talk about that.
So do you agree with Michael Hartnett that if Treasury Secretary Scott Bessent get dragged the 10 to the 30-year below 5%, that'll spur some sort of sell-off in equities into midterm elections?
The timing will always be really hard in terms of what might be the event that forces equities to reprice things. I'm old enough to remember it took roughly a 3% rally in yields in '87 before the equity market woke up and had a, oh, that's bad moment. And that was really bad with the market down 22% in a day. We haven't seen that scale of a 3% move higher in yields, but then again, yields were much higher in 1986, 87 than they are today. So maybe I have to go back and look at my fixed income history and find out how do I scale 3% then, 3% in 94 wound up being really bad for markets in 94, 95. And maybe it's only a 1.5% move today, given the low base math that we wind up working with. But if companies can come back and say, you know, news is great, look at how much money I made, ignore my tax refunds, look how much money I made. And then I think equity investors remain committed. This is the momentum market. And I think the challenge with momentum being a feature of the bug is that we go up, 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 and then we go down really sharply. And you had that old saw, markets go up a staircase and down an elevator.
Where's the momentum now?
Momentum has, I think, I think the issue within equities is people are, not to say tired of talking all AI all the time, but given that it is all AI all the time.
Are you tired of it?
No, because it's so interesting to think about the consequences, but I am trying to find things. Can I find stories that are not just tied to AI? And that's kind of hard to find. I mean, effectively, the financials have become an AI trade.
11 weeks of gains until this week. It's quite a run for the financial.
Financials had a nice run. Healthcare is beginning to have a nice run. And I don't think healthcare is necessarily as tied to AI. It might actually help them get a little bit more efficient. And one thing we do have is an inefficient healthcare system here in the United States. So every little bit helps.
Are small caps an AI trade?
They become one on a very granular basis when you start trying to find. I think the last year has been one of what's short next. It's sort of like little kids read Where's Waldo? And now I think in the equity market, you're looking for what's the next component shortage. And in that regard, small caps may find themselves sitting on some unique little transistor capacitor that suddenly no one's invested in and suddenly wind up needing. You know, whether it was, who would have thought that we'd be talking about, you know, memory as being short when you have this business which chronically never made money and suddenly has 80% gross margins forever.
Right. So this is an interesting point. This is notable given the backdrop. The Russell 2000 is up more than 20% so far this year. Equal weight up almost 15%. The S&P market weight up almost 12%. The outperformance very much has been some of these other companies. And the question is, are they getting efficiencies from AI? But you're raising another point, which is they might make a widget that goes into the AI build out that somehow is benefited more significantly. And they too are levered up to all of this.
It's effectively, you know, structural underinvestment from years is biting us. And that you suddenly have to spend your time thinking, what's the next shortage that I have to deal with? You know, we wouldn't be talking about a 25% price cut for ground beef if we didn't actually have one of the smallest cattle herds in U.S. history. So you wind up working through this idea of as everyone's run a very efficient balance sheet for years and years and years, and they've been rewarded for running a very efficient balance sheet for years and years, suddenly you find yourself in an environment where maybe having a little bit of cushion is actually a prudent thing to have. And having a little bit of a cushion in an environment with rising prices actually winds up giving you inventory profits. I realize you had to have been thinking about the world in the 70s when you last had companies having inventory profits, but you're back to an environment where having some inventory around is actually a pretty good thing.
Jack, it's good to see you. Always is. Thank you, sir.
Thank you.
Thanks for dropping by. Jack Caffrey there of JP Morgan Asset Management says he's not bored. Sounded like he was on the edge of board at one point, right? With the AI trade. Or everything's AI right now.
In fairness, you can understand it because it's almost tedious in its repetition over the years, especially given some of the big numbers that have caused all of us to become benumbed to the concept of how much money we're actually
For me was utilities, Brahma. Utilities traditionally a defensive trade, right?
Yeah.
All of some utilities, just this explosive AI trade that traded in line with big tech.
Yeah, I remember how excited GE Vernova was when they was like the hot thing. And the CTO was incredibly excited to talk about the turbines that were in hot demand.
Still in hot demand. Nasdaq futures this morning up by 0.6. Let's give an update on News Worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
John, thank you. Treasury Secretary Scott Bessent says the US will reveal on Monday its plan to economically isolate Iran and its trading partners. Bessent is set to hold a news conference to talk about exactly what will be done. The announcement coming a day after President Trump threatened an economic D-Day on Tehran. New tensions emerging in the Asia Pacific. The US, Japan, and South Korea holding a three-way call to coordinate a response after North Korea fired a barrage of short-range ballistic missiles yesterday. Gold on track for its third weekly gain, rising more than 5% this week after the Treasury surprise debt buyback boosted the precious metal. Gold has been trading around the $4,000 an ounce mark since July, but it's down around 15% since the start of the Iran war. And that is your Bloomberg brief. John.
Vonnie, thank you. Up next on the program, doubling down on debt.
Anything that happens within a 24-hour period is noise. We are trying to bring the market back into equilibrium in a thinly traded market.
Up next, John Lever, FE Racer Group, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Great.
It's Bloomberg.
This is your trade.
This is Wall Street Week. Welcome to Balance of Power.
We're watching Bloomberg Deal. Welcome to Bloomberg this weekend.
This is Bloomberg Television.
Equity futures positive by a third of 1% on the S&P 500 on the Nasdaq. We've had by 0.6. And giving this in debate when it's a share which Ramo asked me as we're coming back from commercial break. Meghan and Harry back to Britain.
Yeah,
How do I
about
feel?
that?
I couldn't care less.
Okay, great.
You
How do
know,
you feel about their ambitions and political
wish people would take that position on a range of things. They just don't care.
Okay, thank you for letting me know.
Does that help?
Thank you.
Thank you for trying to derail me, though. I appreciate that. In the bond market right now, 2s, 10s, and 30s shaping up as follows. You're getting a feel for what happens here now, behind the scenes. 525 on 30s this morning, just about unchanged. The focus on the bond market in a big way so far this week, with all eyes on the Treasury Secretary under surveillance this morning, doubling down on debt.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focused on physical consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market,
So here's the latest this morning. The Treasury Secretary, Scott Bessent, is ready to expand debt buybacks, saying the administration will be unveiling a new fiscal initiative in the coming days. Bloomberg's Tyler Kendall joins us now from Washington for more. Hey, Tyler.
Hey, John, good morning. Well, at this point, as you're outlining, the Treasury Secretary saying that he has a big toolkit to bring down bond yields. We're still waiting further details on what this new fiscal push is going to look like, though it is our understanding that details are expected to be unveiled early next week. The Secretary went on to say that he and the Budget Director, Russ Vought, have been tasked with fiscal consolidation and seem to point to the potential for a fraud task force that could save hundreds of billions of dollars. In his words, he also seemed to zone in on the idea that the government is examining the money sent to states and what could be cut back. But the political reality here in Washington is that it is difficult to cut spending or find savings, especially during an election year. If we look at the Treasury Department data released earlier this week showing that $40 trillion U.S. public debt threshold. At this point, that included that record July budget deficit that was fueled by a surge in Medicare and Social Security costs. John, I'll also point out that the Treasury Secretary did talk about this influx in tariff revenue as the administration keeps lobbying on new levies after the Supreme Court struck those down earlier this year. But a new analysis out by the Tax Foundation just last night does say that the U.S. government is not yet back at those levels before the Supreme Court case, as the U.S. has changed tariff policy 50 times since January of 2020.
$40 trillion debt pile. Tyler Kendall, the latest in Washington. Tyler, thank you. John Lieber, FUH Group, writing this. Bessent has been reaching for norm-breaking tools to break down the borrowing rate. His long political leash was shortening each time an intervention fall short of his market goals. John joins us now for more. John, welcome to the program. There has been a chorus on Wall Street saying something very similar, which sounds like this. To address a structural issue, you need to have a structural solution. And John, that solution is doing something about the deficit down in Washington. And as many people have said on this program, they won't do anything about it until it helps them get elected. So how bad does it need to get before it becomes a campaign issue?
Well, much worse than today, and we may be on that path, for better or for worse. I think that, you look back to when the last time the fiscal deficit was a huge political issue was in the kind of opening days of the Obama administration, where Republicans found an opening because of Obama's stimulus plans and the ACA. But before that, you look at President Bush's spending and the tax cuts during the Iraq War after 9/11, and then before that, you look to the 1990s when it was the bond vigilantes that really spooked the then Treasury Secretary and the President of the United States into doing something. But the political reality in each of those previous eras was quite different than it is now. In the 90s, I think that you had a uniquely concerned and vulnerable set of policymakers who were coming off an era when the budget deficit was a huge concern in the 80s. In the 2000s, it was political opportunism driven by Democrats, and of course, the massive shift in the country from going from surpluses to deficits after the dot-com boom. And then in the 2010s, it was, again, political opportunism coming after the GFC. So I think that, what's happening right now is you're seeing this upward pressure on bond rates globally. Perhaps this is because of a shortage of capital in the face of the AI boom. Perhaps it's because of the declining credibility of the United States and Federal Reserve Chairman. But I think that you need a lot more of this political pressure and the political opportunism to make this a real issue. This could be something we're talking about in the 2028 presidential campaign. If interest rates get high enough that Americans really start to feel the squeeze, but neither party has a solution here. So therefore, it makes it pretty tough to campaign on.
John, do you think you can make the argument also in a shift in Republican ideology, or at least the ideology that guides the party, that this president is a big government guy?
Yeah, absolutely. And it's, we don't know what the successor is going to look like. We don't know if it's going to be J.D. Vance, who wants to put more interventionist, big government type ideas, or Marco Rubio, who I think looks a little bit more like your old school style Republican, or somebody else who comes in with a totally new agenda. But absolutely, Trump has upended the ideology of the Republican Party and really degraded their credibility when it comes to cutting deficits. It's going to take many years to bring that back. And so I think that the debate is going to happen well before that brand is recovered.
Treasury Secretary Scott Bessent yesterday said that he would unveil some fiscal steps, new fiscal initiatives to address the deficit in the coming days, either later today, maybe Monday or Tuesday of next week. Given what you just were saying, the point John was making, like you made in response to John's question about the Republican zeitgeist right now, what will they actually be willing to do to curtail some of the budget deficit?
Well, one thing that did strike me about Besson's comments yesterday, he said that they would be looking both at spending and revenue. There has been some concern among Republicans in Washington that President Trump was willing to give in on something like a millionaire's tax or do something that was something from the progressives playbook. And we know that Trump and Besson talked about this explicitly, thinks tariffs are a great way to raise revenue. So that could be somewhere in the toolkit. You've got to kind of divide the world into things that the US can do, or excuse me, the president and the White House can do unilaterally, and things that the president and the White House needs Congress to do. If they need Congress to do anything in the tax space, they need Congress to do anything significant in the spending cut space. I mean, of course, they did DOGE in the opening days, but that didn't actually result in a lot of savings. But the one tool they have that they can do really on their own to address the deficit, and they've already done to some degree, is tariffs. Now, it's kind of hard to see them massively ratcheting up tariffs right now from the level that we're at. But on the other hand, that is the tool they have in their toolkit. When they talk about revenue, I would expect something there. Honestly, I think this is going to be something like a commission, or, earlier you mentioned the fraud task force or something that I think it's going to be very easy for markets to look through and not take seriously.
I'm losing track of all the task forces that we have to follow as they come out with prognostications. Given the fact that tariffs are one potential revenue source, how do you square the move announced earlier this morning by President Trump to allow some tariff relief for some ground beef importers, given the fact that that's also a tool to potentially lower consumer prices?
Yeah, I mean, this is the other side of the coin that presents them with a really impossible dilemma, is that they have this massive concern, these fluctuations in the bond markets that are driving quite a bit of concern, and then they also have these affordability concerns for everyday voters who are facing some of the blowback from the Iran war, and of course the higher tariffs. I think that these ground beef exemptions, if we look at them, they're not going to add up to much. But when you pile these exemptions on top of one another, of course, the fact that they had the IEPA tool taken away from them by the Supreme Court, you start to see more and more holes in this tariff wall that I think makes it harder to rely on that as a long-term source of revenue. And if you want to raise revenue here, you have to raise taxes.
John, it's good to see you. As always, thank you, sir. John, leave it there. If you raise your group, anyone campaigning for that into the midterms? I don't see that right now, the Republican side of things.
For more tariffs, they could potentially offset the increase in the budget deficit. If you increase revenues, it's going to come from unpopular places, either tariffs or higher taxes.
On campaigning to cut the tariffs, by the way, either on either side. That's not even part of the conversation.
Former President Biden did not cut the tariffs that President Trump in his first term put on. Typically, they tend to be sticky. It's a one-time price adjustment, and then people just sort of allow it to happen in the backdrop. You just wonder, how do you pull a lot of levers going into the midterm elections while addressing concerns of markets that are longer standing structural issues?
Supporters of the president might be uncomfortable with the idea of him being a big government guy. Here's the problem. The president's a capitalist, and outside of the Oval was to borrow money, invest, and take risk. When you're inside the Oval and you borrow money, invest, and take risk, you're not a capitalist anymore. You're something else. You're a big government guy. And you're setting the stage for anyone who comes next to do the same thing. And the government just gets bigger and bigger and bigger, and we don't address what we need to address.
And part of the reason why is it's not popular. Anyone who mentions that there are going to be certain benefits that are going to be reduced or taken away, or that the retirement age is going to be lowered or raised, gets nowhere when it comes to this election cycle.
Up next on the program, Bob McNally of Rapid Energy to talk about the energy market, warning that crude could trade back above triple digits later this year.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television. Key investors, top executives, global innovators join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda Ahmed.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
I'm David Weston. Joining you each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road to look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Is
They said every citizen should be investing in the market.
accelerate progress in all fields of science. Watch Wall Street Week right here on Bloomberg. More than what you need to know, what you need to think about.
Equities down on the week by close to 2% on the S&P, down by close to 1.9, still around 2% from all-time highs on the S&P 500 futures this morning. Positive by, let's call it 0.5, up 0.8 on the Nasdaq just to round that out. Let's do some single names, some morning movers, 2 hours out from the opening down. Bonnie Quinn has more. Hey, Bonnie.
So we start with two heavily shorted discount retailers, and they both beat, right? But we have a very different stock market reaction to both of them. BJ's Wholesale Club beat. It also increased its membership, and to that point, membership fees were up 10% in the quarter. So a great quarter really for BJ's Wholesale Club. It is, though, one of the heavily shorted stocks that investors sometimes punish. It has been volatile in the pre-market, and it's concentrated on the East Coast. It's also one of those places where, it's for the weekly grocery shop as opposed to a Sam's Club, which is more for your monthly grocery shop. So this is more of a smaller wholesale club, but nevertheless, it has done extraordinarily well in the quarter. Its chief commercial officer also set to retire. That may also be impacting this stock. If we look at Ross Stores, is another story. It's up 27% year to date, and another 8% in the pre-market. And Ross also beat and raised. In fact, it raised for a second time this year. Ross has been doing extraordinarily well. It's even brought back in lapsed customers, whatever that means. I guess customers who have stopped shopping there have started shopping there again. And then finally, let's look at some of the gold miners, because obviously as gold goes, so do the miners. And they've been having a fantastic year and been tracking gold higher as we've seen gold rise since the beginning of this month. UP mining up 3%, Barrick mining up another 2.5% for an amazing week. It's an interesting rally. It's on the debasement trade because obviously it wasn't really ahead during the war. At the beginning of the war, gold rose, but then all through the course of the war, we saw gold decline, and then it just picked up again like that at the beginning of August.
Bonnie, appreciate the update on some single names going into the opening bout a few hours from now. On our radar this morning, Samsung unveiling plans to return upwards of $79 billion to shareholders this year. It follows a similar move by rival SK Hynix earlier this week. The combined returns are set to deliver over $100 billion to shareholders to chip makers. Elsewhere, Anthropic is set to match or surpass the size of SpaceX's record-setting IPO. Sources telling us here at Bloomberg the company could file for its public debut as early as this month, Citi set to join the big Wall Street banks working on the mega listing. And finally, Treasury Secretary Scott Bessent set to hold a news conference this Monday to announce details of the US plan for economic warfare on Iran. Bessent saying, quote, "This is going to be the greatest coordinated economic isolation in the history of the world."
So we don't really have many details of this, and this is what we were talking about with John Loomer. Given the fact that they don't have that many tools left that they can execute on their own, a real question about what they can get political clout together to curtail some of the budget deficits that are really causing the issue. Do you think that, or do you think this is going to be another task force?
The word here is coordinated, which implies someone else is joining in, right? That's what it implies. So how many allies has he got together to do something that we don't know about yet?
Yeah, allies being what the Federal Reserve have been talking about, or is it international, or is it potentially in Congress? At this point, there isn't political will to actually cut some of the expenditures. So without that, it has to be a revenue increase that could potentially offset this. A millionaire's tax for President Trump doesn't seem likely or politically palatable. Looks more from the Democratic Socialist of America party than it does in his Republican Party. Nonetheless, you know, crazier things have happened in the face of crisis.
So he said something interesting in college yesterday. I'm talking about the Treasury Secretary. He said that I have asymmetric information. I have information that you don't have. And obviously he wants to introduce some two-way risk to financial markets. I understand that ultimately. But it did make me wonder about what does he know that maybe we don't know. Is the BOJ going to hike interest rates in September, a bigger hike than maybe people expect? I don't know. But clearly, the Treasury Secretary is trying to introduce some two-way risk into this bond market.
If anyone here today should talk about gold, should say at what point is the U.S. can potentially reprice gold holdings in the United States to offset the budget deficit or even outright sell it, that could potentially create the revenue to ameliorate some of this backdrop? Or is this potentially something like you're saying, which is a broad-based hike around the world? But what happens if the Bank of Japan hikes rates and the U.S. doesn't, or even cuts rates at the front end? You know, you start to imagine quite a bit of volatility coming to the FX channel.
Crude this morning. Let's talk about oil. Crude coming off 5 straight days of gains as the US ramps up pressure on Iran. Bob McDally of Rapid and Energy predicting Brent could trade back above 100 later this year, writing, quote, "Military escalation is more likely than a diplomatic deal. At some point, unwarranted market optimism will fade, and then crude oil may move materially higher following cracks." Bob joins us now for more. Bob, welcome to the program. We spent so much time talking about one war. There's another war we need to spend more time on with regards to energy, and that's the situation in Ukraine and the situation with Russian refiners. Bob, how much has changed in that situation over the last year or so? What does it mean for the amount of diesel, the amount of refined product on the market?
John, great to be with you. And you put your finger right on it. You know, last year, we got word and alerted clients the Ukrainians would start using their increasingly capable long-range strike capabilities to go after Russian refining. And they have something like 40 to 50% of capacity is out. I've seen some as high as runs being 50 to 60% lower. And as a result, this last couple of months, Russia has had to ban the export of diesel fuel. Russia is the second largest diesel fuel exporter after the United States. And you see the results, $100 plus diesel margins, 5 times the normal level. And this is unprecedented, record high, and it's probably not going to ease too much going forward. And the Russian and the Ukrainians are probably going to keep up that pressure. We do hear, John, they may switch a little bit to LNG facilities and gas, especially as the European ban on long-term LNG imports goes into effect in January during the winter. But we think they're going to keep the pressure up. And we've seen now, whereas crude oil prices have been sort of spasmodically oscillating in the $70 to $100 range, product cracks, product markets are doing the balancing. And a lot of that is due to that expansion of the war to Russia and those Russian diesel exports.
Well, this is about the time of the year people start thinking about storm season, hurricane, and what might happen through the Gulf of America. Bob, how are you thinking about that and how vulnerable we might be on the refining side in this country?
Yeah, we've crunched those numbers. You know, we look at times when we've had elevated refining throughput, like we certainly had. The United States refining margins, again, all-time high, sustained in the 95 to 97% range. I mean, we're just seeing new things here in energy and in oil. And when you run those units that fast, the risk of unplanned outages goes higher. It could be 600,000 barrels a day. Christmas has come early for refiners. One reason why China is buying a little more oil to let its refiners make a margin. We just don't have a lot of spare refining capacity, so they're running hard. These units need to be repaired, though. They need that maintenance, or the risk of unplanned outages contributed to by storms, as you mentioned, goes up. So it's a real risk. There is no margin for error in the global refining system, with runs already down in the Middle East and Russia, as we just discussed, and in China still being curtailed. No margin this fall for storm-related damage.
Earlier in the show, we were talking about how exhausting this year has been for many people, even if there haven't been that many big moves. It must be that much more exhausting for an oil trader, given that the moves have been incredibly volatile and oscillating, as you said, spasmodically between $70 and $100 a barrel. How thin is trading at this point, given how burned so many different traders have been over the year?
It's thin. I was just looking at open interest on an IMEX futures contract, loitering well below historical levels. And just anecdotally talking to traders, they're out. They've just lost too many fingers and toes trying to go long and to fight the tape, if you will. We were talking earlier about the administration sort of defending levels in bonds. Well, they've also been defending levels in crude and doing it successfully. And they've lost so much money that a lot of bulls are just sitting on the sideline saying, on crude anyway, you know what, we're just going to let this thing roll for a while. All of the activity has been on the crack side, again, with the gasoline and diesel cracks being high. But yeah, there's exhaustion, there's fatigue, and there's non-participation, really. And I think you're going to have to see either continued further draws in inventories, and these data come to us with gaps and lags, so it takes a while, or if the conflict escalates and we have more material damage to major facilities in the region, you're going to probably need some catalyst to get big wholesale, I think, participation by these exhausted traders, at least in the crude side.
One buffer to prices going materially higher in the oil market is in China, and the fact that they had such huge stockpiles that they didn't have to import much oil. There seems to be some shift in that. You're talking about how they're increasing their imports to refine some of the product because they can make a margin. There are reports that the stores coming from Iran going to China are running low and are actually being blocked by the blockade put on the Strait of Hormuz by the United States. How could that potentially affect the equation in terms of pricing?
It's a very big deal, Lisa. Probably the biggest surprise in this whole episode has been China going on a crash diet, if you will, for its crude imports, stopping its SPR fill, curtailing product exports, et cetera, abruptly dropping like 5 million barrels a day. That wasn't on my bingo card, and we had anticipated more moose disruption last June. We didn't expect that. China is coming off the crash diet and beginning to buy. As you noted, their estimates are something like 40 million barrels or so of Iranian crude floating around Malaysia. Nearly all of it has been sold already, so those teapots maybe have access to 10 or so. The U.S. blockade is in effect. Iran is not exporting anymore. We expect China, as it returns to buying crude, not galloping, not back to pre-war levels, but it's coming back. It wants to keep product stocks high and wants to let refiners make a little bit of that early Christmas money that they're making right now. And so as China returns to buying, they're going to have to come to other Middle East barrels, to the United States. Those are maybe medium sour barrels. So, pretty tough to get by these days. And that's going to put upward pressure on prices. One more reason why Rapid N sees oil prices, crude prices grinding higher.
We're in the process, Bob, of processing some headlines coming from the Iranian president. I'll share it with you. It comes from a semi-official news agency in Iran. Here's the quote. "It would be better to win the war today, now that we're strong and have dignity, with the whole world acknowledging our victory. What was achieved during the negotiation was a great achievement that was approved in the Supreme National Security Council with unity and solidarity. We will not find a single clause in this agreement that suggests capitulation." That's from the Iranian president. The move in crude is pretty muted, I have to say, down only 0.4%. So, Bob, I don't think the market's seeing this as some kind of imminent deal or closure to the tension between the US and Iran. Bob, the question I would ask of you is, who has the power in Iran to make that decision? And how close do you think we are to any kind of deal, sustainable, durable agreement between these countries?
You know, it's not the president, unfortunately. I think he is the dove. I think he would like to make concessions and bring this to an end. The hardliners are in charge. Ghalibaf and others. All I hear from folks in Washington and my colleague Scott Liddell is a former CIA field officer focused on Iran, fluent Farsi, et cetera. Scott, you know Scott. Scott tells us the hardliners are in charge. They think they're winning. They think time is on their side. They, with the Houthis, want to get the crude oil price up. They think they're going to compel President Trump to capitulate, President Trump to make concessions. They want to get back to that MOU. They said, look, we'll let Hormuz flow, but we want cash, we want money, and we want sanctions relief. We don't think the U.S. is there yet. We think the hardliners are in charge. So the president can say there's a debate in Iran. There is a debate among doves, as there is in Washington, but we think the hardliners in Iran are call the shots and they're in charge.
Hey, Bob, thank you, sir. Appreciate it. Bob McNally there of Rapidan Energy Group. Off the back of those headlines, crude flipped negative, down only 0.5% on Brent, 93.30 on Brent crude. Equity futures near session highs.
Yeah, and you can see the dollar gaining a little bit as well, which is sort of this interesting cross-asset trade of headlines that may or may not have any import whatsoever in thin markets where essentially a lot of people are trying to control a lot of different things.
It's a little bit lower as well. Yeah, to your point. A lot of people trying to control a lot of things. 30s right now, 5.24. With an update on news worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The USS Abraham Lincoln and its crew of 5,000 sailors are leaving the Middle East for their 13,000-mile journey home after 272 days at sea. Sailors aboard the ship have not had any days off to rest, and families are raising concerns, including about shortages of basic supplies. We have a winner in this week's special runoff in California to serve the rest of former Congressman Eric Swalwell's term. With 95% of the votes counted, the AP projects State Senator Aisha Wahab as the winner. She will become the first Afghan American to serve in Congress. Soccer fans from all over the world launching a petition calling for FIFA President Gianni Infantino to resign. This after he tried to sell future World Cup profits to private investors. Infantino has so far resisted calls to leave office. And that is your Bloomberg brief.
Vonnie, thank you. Appreciate it. More from Vonnie in the next hour. Up next on the program, questioning credibility.
I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve. I was very supportive of the July poll and continue to look at the information.
Up next, Molly Brooks of TD, live from New York City. You're watching Bloomberg TV.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for